Welcome to F7, and today we're going to be looking at how to answer an F7 exam standard question in 10 easy steps. Now, the most important thing to realize is in F7, even though it's got a bad pass rate or has had a bad pass rate recently, there are basically 3 skills you need to know. Skill number 1 is consolidations, which we're going to do today. Skill number 2 is published accounts. And skill number 3 is your cash flow and or interpretation. And the rest of the questions, the next 2 questions, of course, are on standards. So the biggest thing, of course, for you is to master consolidations. Imagine if you picked up your exam paper and you got your consolidation question to balance. I just spoke to a student who's expecting his results in the next few days as I was walking into the studio, and he says that he didn't balance the questions, but he's absolutely confident he's going to pass. Now that's nice to hear, because you don't need to balance these things. Of course, I've got to, but as far as you're concerned, as long as you show some skills, the kind of steps I'm showing you, and you present it in a reasonable style, showing that you've done some questions before, you will completely and utterly sail through this exam paper. It's so simple to pass F7 if you're good at consolidations. That, of course, is a quarter of your exam. Next image I want to show you is the question I'm going to be doing. This is the June 2009 question 1. And the reason I've selected it is the ACCA have sent students doing F7 an F7 alert saying for consolidations the most important question is pacemaker, and that is the one I'm going to be doing. I have, of course, updated it to allow for all the recent changes, the latest International Financial Reporting Standard. Well, by the way, my name is Francis Braganza. I teach F7 at Lsbf Interactive and have done for more than a quarter of a century, have done this subject. The 10 steps I want to look at with you are as follows. I'm going to show you the question approach, how you approach a question like this. It's quite overwhelming at first, but I want to show you that there's absolutely no problem with conquering a question like this and easily scoring 20 out of 25, if not all 25. It is so simple. The question approach, I'm going to convert the marks into minutes. I'm going to show you my personal technique where I open up a blank consolidated statement of financial position, and I'm going to think about the associate valuation with you. Beyond that, of course, there's the group structure, and in the investment check, as you can see, consolidation adjustments, big marks there. Then you have your time apportionment. There's a particular problem with this question. Presumably that's why it's in the F7 alert that the ACCA have warned us about. Then there's a net assets list, the valuation of the associate, and then the big 3, big marks, of course, goodwill, NCI, consolidated reserves, and then we're going to complete the CSFP, as you can see on the screen. So the question approach, this is the first step I want to take. This is the question itself. Please have a read of the question, get familiar with it, and then you and I will solve it. We'll absolutely demolish this question. But first you must read it and come to terms with the challenge in front of you. So we have there Pacemaker, Cyclop, and Vardine, 3 companies. Usually the company that begins with P or H is the parent, H for holding. S usually is the subsidiary, and A is usually the associate, but this time the examiner uses a name like Vardine, but don't worry about it. The question will have 1 subsidiary and 1 associate. So if you decided who the subsidiary is, the other one must be the associate. So this one begins with V, so who cares? Vardine, as it says. All right, so Pacemaker, Cyclop, and Vardine. The rest of the question there, equity shares of $1 each, share premium, retained earnings, non-current liabilities. The retained earnings, of course, are quite important, so I might just highlight that. The non-current liabilities, 10% loan notes, current liabilities, etc. So please get familiar with the question. Of course, you can download it from the website, June 2009, don't forget. Except, of course, I've updated it, so it may be better to use my version. So what I did was I pretended I was the examiner, put on the hat of the examiner and said, now, suppose the examiner were to have rewritten his pacemaker question today for the coming exam, how would he have reflected the latest IFRS, number 3? So it was great fun doing it, of course, because it's nice to be the examiner occasionally and to think the way the examiner does. The examiner, of course, is Steve Scott, and I would suggest you follow any articles he writes in Student Accountant or indeed PQ Accountant, which is an excellent free magazine you get, where the editor cares very much about the small student and interviews the examiner and gets tips from the examiner, etc., for our benefit. It's called PQ Accountant. You can get on the website and register free of charge, or you get the magazine free of charge. And, of course, Student Accountant is absolutely excellent. But those two magazines I'd strongly recommend. So that's your question. Beyond that, I'd like you to read step 1, the question approach. It is a public listed company that require the following investments. Investment in Cyclop. So your pacemaker, you've invested in Cyclop on the 1st of April 2009. Don't forget, the CSFP date is, in this particular question, the 31st of March 2011. So the 1st of April 2009 feels like 2 years before the CSFP reporting date. So you've got to be careful with things like depreciation, accumulated depreciation on the fair value adjustment, etc., as I'll show you. So you acquired 116 million shares in Cyclop. If I just go back and show you how many shares there are in Cyclop, 145. So this is your pacemaker company. This is Cyclop, and this is Vardeen. So if you take your 185 and you were to divide 116 by that 145, that percentage, of course, is 80, as that becomes a subsidiary. What else can I say? There's tremendous detail there which I'd like you to have a read of. For an immediate cash payment of $210 million and issued at par 10% $100 loan note for every 200 shares acquired. So do underline the word acquired. Cyclops' retained earnings at the date of acquisition was $120 million. That's what we call pre-acquisition. At acquisition or pre-acquisition. And investment in Vardeen on the 1st of October 2010, do be careful. That date, if you look at it very, very carefully, if you count from there to the year end, or indeed from the start of the year to that date, you can see there the number of months. 6 months, it's mid-year, you see. Mid-year acquisition of a 30% company must be an associate. So an associate is anything between 20 and 50. If it goes above 50, of course, it's a subsidiary. And if it's less than 20, it's just a trade investment. So let me just run through that again. From 0 to 19.9, if you like, is an ordinary investment, trade investment. From 20 to 50 is an associate. And above 50, of course, you have a subsidiary. So never forget that little rule. I don't confuse it with your F6 tax definitions of associates. Be careful, that's completely different. So each subject is different, and that I'm sure you've realized if you've done any ACCA papers, they all have their own characteristics. So you mustn't be mentally lazy and apply F6 rules to F7. You get into great difficulties. So there you are. We have here the situation where you have an 80% subsidiary and a 30% associate. And Pacemaker's other investments and those of Cyclop are available for sale, investments which are carried at their fair values as at 31st of March 2010. The fair value of these investments is 82 million and 37 million respectively. And so it goes on. The next part of the question, Pacemaker's policy is to value non-controlling interests at their fair values. The directors of Pacemaker assess the fair value of the non-controlling interest to be this figure. So that's used for NCI, non-controlling interests. There's been no impairment to goodwill. That's good. At the date of acquisition, Cyclop owned a recently built property that was carried at its depreciated construction cost of 62 million, but the fair value is 82 million. So can I say it's gone up by 20? What's called a fair value adjustment, and you divide that by 20 years, and that's 1 per annum. So these are things you're doing in the first few minutes of picking up the question. And then there's something about brand valuation. You can have a look at that. And something about inventory. All of these things we will see in due course. It then says Vardine's profit is subject to seasonal variation. That's a little bit of a challenging point. So we'll do that in due course very carefully. So please have a read of the question. And then it says, prepare the consolidated statement of financial position. No problem with that. Now, how you account for an associate is something you must absolutely know. Basically, what happens is if you buy, let's say, Vardine, that's me, you be the parent, I'll be the associate Vardine. If you buy, say, 30% of my company and you pay 120,000, and then my company has grown by, say, 80,000 since the date you acquired till the year end, when you're reporting. What you do is simply add your 30% of that 80, which is 8324. You add that 24,000 to the 120,000 earlier. So if you add how much you paid for my company, to that you're going to be adding how much the company has grown by. You take the 120 and you add your 24, as at the year end, therefore it's valued at 144. Absolutely straightforward, as we will see. And that's basically what I'm showing you on the screen. So, let's summarize. Use the reading time to analyze the requirement and to skim read the narrative. There's plenty of narrative on F7, so you must be prepared to read all of it. The requirement drives the question and must be considered first. I always think that these big questions are done better from the bottom up, so to speak. Have a look at the requirements and then start the question. Because once you read the requirements, you're much more focused. Skim the narrative during the reading time, then work through line by line, linking the narrative, where possible, to the requirements. That's what I'd like you to do. So you look at the requirements and see if you can link it to the narrative. Now, the 15-minute reading time that you have, I would suggest read the entire paper during those 15 minutes. As you know, ACCA give you 15 minutes on top of your 3 hours. The 15 minutes must be used to read the whole question. It'll help you to pick up the best order in which you must do it. Of course, your timings as well are extremely important. And the question structure, etc. I would do my best question first. If you like consolidations, just do it first.